Welcome back to the deep dive.
Great to be here.
So you sent us Santander's 2024 financial report, a big one.
Indeed. Lots to unpack.
And as always, we're here to pull out those key insights for you, make sense of it all.
Exactly.
You wanted to get a handle on Santander's performance, what the really crucial numbers tell us, and, where they seem to be heading.
Right. And this report gives a pretty detailed look structured around their five main global business segments now.
Ah, that's a change, isn't it? From
Yeah.
the old regional setup.
It is. They shifted. And this new way lets us see more clearly, I think, where the growth's really happening and maybe where the challenges are cropping up in specific business lines.
Okay, good. So let's dive into those five segments then. What were the main sort of trends and takeaways you saw?
Well, the biggest piece of the pie is retail and commercial banking. Let's just call it retail.
Okay.
This is your everyday banking individuals, SMEs, bigger companies too, but it excludes the consumer financing card stuff.
Got it.
And what really jumps out here is the profit attributable to the parent. It shot up 29% year on year in constant euros.
29%. Wow.
Yeah, reaching EUR 7,263 million. That's a significant number.
So what drove that?
It seems to be a combination, really. Their income grew, they got better at managing costs, improved efficiency, and they also needed to set aside less money for potential loan losses, lower provisions.
Makes sense.
Their efficiency ratio, basically cost versus income, improved quite a bit to 39.7%.
That sounds pretty good for a bank.
It is. And their ROAD, that's return on tangible equity, a key profit measure, climbed to a very healthy 18.9%.
So the core banking engine looks strong, maybe helped by interest rates.
That's likely a factor, yes. Definitely suggests their main operations are firing well.
All right, so that's retail. What about the digital consumer bank? How did that fare?
Okay, the digital consumer bank or consumer, this bundles things like consumer finance, their online bank, open digital services, and SB&A consumer. Here, the picture's a bit different. Their net operating income was up 11%.
Still decent growth.
It was, but their actual attributable profit decreased by 12%, down to EUR 1,663 million.
Oh, okay. Why the drop in profit despite income growth?
The main reason they cite is the normalization of their cost of risk.
Cost of risk. Remind us.
Think of it as the bank's estimate of loans that might go bad. After maybe a better than usual period, this cost seems to have returned to, well, a more normal level. And that hit the profit for this segment.
I see. So higher expected losses pulling down the bottom line.
Exactly. Their efficiency was still good, 40.1%, but the ROE was lower here at 9.8%, suggests that while revenue's growing, profitability took a hit from credit costs.
Different dynamics there, definitely. Okay, next up, corporate and investment banking.
Yeah, the CIB. This is for their corporate and institutional clients globally, and they often work with the other Santander divisions.
Right.
The report doesn't give a specific profit number for CIB alone, but it does flag a strong ROE of 18.1%.
18.1%, also pretty strong.
Yeah, it indicates that serving those larger clients is generating good returns on the capital they've put into it. Quite profitable.
Okay. And the last two segments.
We have wealth management and insurance, or just wealth. This covers private banking, asset management, and insurance.
And how did they do?
This one really stands out. An exceptionally high ROE of 78.7%.
78.7. Wow, that's huge.
It is. Suggests very efficient, very profitable operations in wealth and insurance.
Okay. And the final one.
Payments. Focused on digital payments, like Paganext and their cards business. Paganext hit a solid EBITDA margin of 27.5%.
EBITDA margin. Measuring operating profit.
Exactly. And for the cards business specifically, they reported a strong ROE of 35.6% and a really impressive efficiency ratio of 30.4%.
So payments are also highly profitable and efficient.
Looks that way. Very different profit profiles across the board, you see.
Yeah, that's fascinating. You mentioned the report also still talks about the old geographical segments.
It does. Europe, DCB, Europe, North America, South America. Until 2023, these are the main segments. So they still provide that regional view.
So Europe is everything in Europe except
what's in DCB Europe, which is mainly Santander, consumer finance, and open bank within Europe.
Got it. And North America?
Mexico and the U.S. South America covers Brazil, Chile, Argentina, and others. It's useful because while the global segments show business line performance, these regional ones help you see how they're doing in different economies.
Right, sort of a matrix view. Makes sense. Okay, let's broaden out. What about overall business volumes? Did lending and deposits grow?
Well, customer funds actually grew faster than loans overall. Gross loans were up, but only just 1% year-on-year in constant euros.
Only 1%. Where did the growth come from?
It was concentrated in consumer, payments, and wealth. CIB was stable, but retail actually saw a slight decrease.
Oh, retail lending went down. Why was that?
They give a few reasons. In Spain, customers were apparently making early loan repayments. In the UK, they said they were focusing more on profitability than just loan volume.
A strategic choice.
Seems so. And in the US, they mentioned optimizing capital. So, yeah, a bit more deliberate on the lending side, perhaps.
Interesting. Not just growth for growth's sake. What about the other side? Customer deposits and funds.
That grew more strongly. Customer funds up 4% year-on-year in constant euros.
Okay, 4%. What drove that?
Mainly inflows into mutual funds and more money sitting in demand deposits like current accounts. They also noted a recovery in customer funds, specifically in Europe.
And the customer base itself, did that grow?
It did. Total customers reached 173 million. That's up 8 million over the year.
8 million new customers.
And active customers rose too by 4 million, hitting 103 million. Plus, those active customers are doing more transactions per active customer, or up 9% year-on-year.
So more customers, and they're more engaged.
Seems like it. They also mentioned focusing on customer experience, saying they rank in the top 3 for Net Promoter Score in 7 markets.
NPS, right? Customer loyalty. Okay, encouraging signs on the customer front. Let's pivot to the big picture financials for 2024. What are the headline numbers we need to know?
Right, the consolidated group figures. Total income hit EUR 61,876 million. That's up 7.8% year-on-year.
Nearly 62 billion euros.
Okay. Net operating income, that's income after operating costs, did even better. Up 12% to EUR 35,842 million.
Stronger growth after costs? Good sign.
Profit before tax reached EUR 19,027 million, a jump of 15.6%.
15.6% pre-tax growth. Impressive.
And the bottom line, profit attributable to parent company, was EUR 12,574 million. That's up 13.5%.
It's still double-digit growth.
Definitely. And earnings per share, EPS, also climbed nicely to EUR 0.77 from EUR 0.65 the previous year. So overall, a strong financial performance shown in these numbers.
Yeah, very solid growth across the board. What about those profitability metrics, ROE and ROTE?
Both improved. Return on equity, ROE, went up to 13.0% from 11.9%. Okay. And ROTE, return on tangible equity, which we touched on, rose to 16.3% from 15.1% in 2023.
Both moving in the right direction. And efficiency.
Also improved. The efficiency ratio dropped to 41.8% from 44.1%. Lower is better here, means they're spending less to make their income.
Good progress on cost control then. What about the core income streams, net interest income and fees?
Both grew well. Net interest income, the bread and butter, difference between interest earned and paid, was EUR 46,668 million, up 7.9%.
Okay.
And net fee income from services and transactions also saw a solid 7.9% increase, reaching EUR 13,010 million. These were clearly key drivers for the overall income jump.
So core banking revenues are definitely powering ahead. You mentioned constant euros earlier for the segment profit. How did that look for the group overall?
Right. Stripping out the currency fluctuations gives an even clearer view of the underlying business momentum. And in constant euros, the growth was indeed stronger. Net interest income up 9.5%. Total income up 9.9%. Net operating income up a chunky 14.6%.
14.6, wow.
Profit before tax up 15.6%, and attributable profit of 15.3%.
So currency movements actually held back the reported figures slightly.
It seems so. The report notes exchange rates had a slight negative impact on total income, but interestingly, a positive impact on costs at the group level.
Huh, complex effects. Got it. Okay, shifting gears slightly. What about loan quality? Any concerns there? How did credit quality hold up?
It actually looked pretty robust according to the report. Their non-performing loan ratio, NPLs, improved slightly to 3.05%.
Lower bad loans. Good.
And the cost of risk, which we discussed for the consumer segment, overall improved to 1.15%. That was actually better than their target for the year.
Better than expected.
Yeah. Although, as noted, it decreased in retail, but did normalize, meaning increase, in consumer. Their NPL coverage ratio, the reserves they hold against those bad loans, is at a healthy 65%.
65% covered. Okay. And the balance sheet size? Capital strength?
Balance sheet looks solid. Total assets reached EUR 1,837 billion. That's trillion euros, with growth in both loans and customer funds in constant euros. And solvency ratios, their capital buffers, look strong too. The fully loaded CET1 ratio, A key measure of core capital stood at 12.8%.
12.8%. How does that compare?
That's comfortably above regulatory requirements and generally seen as a solid level. Their total capital ratio was 17.2%.
Yeah.
So good buffers against potential shocks.
Okay, strong capital base. Now, something many people listening will care about, shareholder returns. How is Santander planning to reward its investors?
They have a pretty clear policy stated. They aim to distribute about 50% of their reported profit.
Half the profit back to shareholders?
Roughly, yes, excluding certain non-cash or non-capital bits. And the plan is to split this payout roughly equally between cash dividends
Money in your pocket.
and share buybacks, where the company buys its own shares back from the market, which tends to support the share price.
So a two-pronged approach.
Exactly, though they always add the caveat that this is subject to future approvals,
Of
naturally.
course. Did they give specifics for 2024?
Yes, they paid out EUR 0.095 per share in cash in May, and another EUR 0.10 per share in November.
Okay.
They also made a point of highlighting the growth in their tangible net asset value per share, PNAV. That rose to EUR 5.24.
TNAV per share, book value.
Tangible net value per share, yeah.
Yeah.
And that figure was up 14% year on year if you include the cash dividends they paid out. The buyback program is also a key part of that value creation strategy.
Right. So returning capital consistently. Okay, let's wrap this up. Looking forward, how does the report assess the road ahead for Santander? What's the overall feeling?
The overall tone is definitely positive, I'd say. They stress the continued strength of their loan book, supported by the macro environment.
Okay.
They highlight that ongoing customer growth and the fact those customers are doing more business with them.
Right, the engagement metrics.
Exactly. The improved profitability and efficiency numbers we talked about are obviously seen as strong foundations. They also point to their diversification across different business lines and different countries as a strength.
Less reliant on any single area.
Precisely. And underpinning it all is that solid capital position, the CET1 ratio. So the report basically concludes with a confident outlook built on these positive trends and their strategy, which seems heavily focused on digital growth and keeping customers happy.
So summing it all up, the report paints a picture of a strong 2024, growth in key areas, better efficiency, a clear plan for shareholder returns, and, well, a pretty confident stance looking forward.
That's a fair summary, I think. Key takeaways are definitely that improved profit, especially in core areas, the customer growth and activity, the solid balance sheet, and that focus on both shareholder payouts and future digital investment.
Hopefully this deep dive has given you, our listener, a much clearer picture of Santander's 2024 based on the report you shared. Thanks for bringing it to us.
Absolutely. It's a DES report, but those are the core messages coming through.
Now, a final thought for you to mull over. Considering these numbers, the growth areas, the challenges maybe in consumer finance, and that strategic focus, what do you think are the biggest opportunities and perhaps the biggest potential hurdles for Santander in the next few years? Something to think about.
Definitely worth pondering.
Thanks again for joining us for this deep dive.
My pleasure.